Imagine losing all your savings in a stock market crash. Now imagine making decisions that not only protect your wealth, but grow it slowly, safely, and predictably. Welcome to The Intelligent Investor by Benjamin Graham, the timeless Bible of investing, the book that mentored Warren Buffett and changed the way people think about money forever. In this video, we'll break down the key lessons, habits, and strategies from The Intelligent Investor in a way that anyone can understand, even if you've never bought a single stock. Let's get into it. Part 1. The Foundation of Intelligent Investing. What is an intelligent investor? An intelligent investor is not someone with a high IQ or advanced finance degrees. An intelligent investor is disciplined, patient, and emotionally stable. Someone who makes decisions based on facts, not emotions. Key point: investing is not about beating the market. It's about not getting beaten by it. There are two types of investors: defensive, passive, seeks safety and stable returns. Enterprising, active, seeks higher returns with more effort and research. This book applies to both. Part 2. The difference between investing and speculating investing versus speculating. One of the biggest traps investors fall into is confusing speculation with investing. Investing means thorough analysis, margin of safety, long-term vision. Speculating means guesswork, emotion, short-term gambling. Most people buying stocks are speculators, even if they don't realize it. Warren Buffett said, "The stock market is a device for transferring money from the impatient to the patient." An intelligent investor does not predict, they prepare. Part 3. Margin of safety, the core principle. Think of the margin of safety like the airbags in your car. You hope you never need it, but you'll be glad it's there when the crash comes. It's the gap between what you pay for an investment and its intrinsic value. Example: if a company's real value is $100 per share and you buy it at $70, you've got a 30% margin of safety. Rule: never invest without a margin of safety. It's not about chasing the highest returns, it's about avoiding the biggest losses. Part 4. Mastering investor psychology, market fluctuations. Our normal markets go up and down. That's just what they do. Benjamin Graham introduces a character, Mr. Market. Mr. Market comes to your door every day offering to buy or sell stocks. Sometimes he's euphoric and overprices everything. Sometimes he's depressed and undersells everything. The intelligent investor? He doesn't listen to Mr. Market. He makes his own decisions based on analysis, not mood swings. Tip: treat the market like your servant, not your master. Part 5. Types of investors. Let's dive deeper into the two investor types Graham talks about. 1. The defensive investor. This is the hands-off approach, ideal for busy professionals, beginners, people who prefer safety over speed. Strategy: invest in high-quality bonds and stocks. Use a 50-50 or 75-25 stock-to-bond ratio. Diversify across sectors, avoid hot tips and frequent trading. Goal: avoid loss and preserve capital. 2. The enterprising investor. This is for the proactive investor, ideal for people with time and skill to research, willing to dig into balance sheets, income statements, can emotionally handle more volatility. Strategy: look for undervalued stocks. Invest in special situations like mergers or distressed companies. Avoid the crowd. Buy with a strong margin of safety. Goal: achieve better than average returns with caution and discipline. Part 6. The importance of bonds. Bonds often get overlooked, especially by younger investors. But Graham recommends bonds as a foundation for any portfolio. Why? Provide income, reduce volatility, offer protection in market crashes. Types of bonds to consider: U.S. government bonds, high-grade corporate bonds, municipal bonds if tax advantages apply. Pro tip: in high market valuations, shift more towards bonds. When the market is undervalued, shift more towards stocks. Part 7. Stock selection for the defensive investor. How should a defensive investor pick stocks? Graham provides 6 criteria: 1. Adequate size of the enterprise. 2. Strong financial condition. 3. Earnings stability for at least 10 years. 4. Consistent dividend payments for at least 20 years. 5. Moderate price-to-earnings ratio. 6. Moderate price-to-book ratio. These filters help weed out the risky, overhyped companies and keep you focused on businesses with long-term reliability. Remember, the best stock is not always the most popular, it's the most stable. Part 8. Stock selection for the enterprising investor. For the enterprising investor, Graham advises, avoid hot stocks. Focus on companies overlooked or undervalued by the market. Use metrics like low PE ratio, low price to book, consistent earnings, low debt levels. Consider net stocks where total current assets minus total liabilities is higher than the stock price. This method is harder, but with more effort comes higher potential reward. Caution requires extensive research and emotional control. Part 9. Dollar cost averaging. This simple strategy is perfect for all investors, especially beginners. Dollar cost averaging means investing a fixed amount of money regularly, regardless of market price. Example, you invest $500 per month in a mutual fund. When prices are high, you buy fewer shares. When prices are low, you buy more shares. Over time, your cost averages out, and you avoid trying to time the market. Graham's message, consistency beats timing. Part 10. Investing in funds. Don't want to pick individual stocks? Then Graham recommends low-cost index funds, diversified mutual funds. Avoid high-fee actively managed funds. Index funds follow the market. They're simple, low-fee. Historically reliable, Warren Buffett agrees. For most people, the best thing is to own a low-cost S&P 500 index fund. Part 11. The role of financial advisors. Should you hire one? Graham says yes, if you lack time, discipline, or expertise. No, if you're just looking for someone to beat the market for you, a good advisor helps you. Create a financial plan, stick to your strategy. Avoid emotional decisions, but remember, nobody cares about your money more than you do. Part 12. Market history matters. Graham urges investors to study past market cycles. Why? Because history repeats itself. Great Depression.com bubble. 2008 crash pandemic recovery markets always bounce between optimism and panic. The intelligent investor understands this and prepares. Lesson. Expect crashes, expect booms. Prepare for both. Part 13. The investor and inflation. Inflation erodes the value of your money over time. Graham recommends investing in equities for long-term inflation protection. Avoid relying solely on cash or fixed income investments. Also consider real estate, inflation-protected securities. Rule, build a portfolio that can adapt, not just survive. Part 14. The Benjamin Graham philosophy summarized. Let's boil it all down. What makes an intelligent investor? Patience, discipline. Independence of thought, long-term mindset. Emotional control, focus on value, not hype. Golden rule, the investor's chief problem, and even his worst enemy, is likely to be himself. Final words from Graham. Graham doesn't promise quick riches. He promises principles that, when followed, will help you build lasting wealth over decades. It's not sexy, it's not flashy, but it works. Because in the end, it's not the market that makes you rich. It's your behavior in the market. Key takeaways. Focus on value, not price. Use margin of safety. Avoid emotional decisions. Know your investor type. Be consistent, not clever. Think long-term. Which of these lessons hit you hardest? Let us know in the comments. And if you found this summary helpful, hit that like button, subscribe, and turn on notifications for more book breakdowns like this one. Until next time, stay intelligent, stay invested.